What sectors should we be most closely watching, especially as we may head back into lockdown, which of course could just prolong the pain for some of the sectors that we are hoping to start to see growth from. Jimmy Jean is with us now, a macro strategist with Desjardins Capital Markets. So Jimmy, great to have you with us. And I did want to start there with that GDP number and how. Let's first start with your overall take on what you saw. Pretty good print on the number. Do you like what lies ahead for Canada?
Well, yeah, I think there's a couple of highlights in what we saw this morning. First of all, there's, you had the preliminary reading of 0.5% heading into this report. And not only it was confirmed, but it was actually surpassed. And now we have another strong preliminary reading for February. So, us heading into this report, we had an above consensus call of 6% GDP for the first quarter. But now I think the consensus is going to be moving towards our call. And if we assume the 0.5% February flash estimate is confirmed for February, then we're talking reducing the shortfall relative to the pre-pandemic level to 2.1%. Another thing I think that's very important to notice here is the big difference relative to the experience of the first wave, and that is in the contribution of the goods producing sector. I mean, since September, you're talking more than half the growth coming out of the goods producers. This is roughly double their weight in GDP. And you look at where the growth comes from, it comes from mining, oil and gas. That's 34% annualized increase over 4 months. It comes from construction, 11% increase. So that all ties in with what we've seen developing on the export side. We had the biggest trade surplus since 2014. And we don't have to explain what's happening in the housing market. Again, today, a 3.1% jump in GDP in the residential construction sector. So the housing market clearly is a big supporter of the economy right now.
Which I guess leads to the obvious question, Jimmy, can we rely on that as we go forward? One of the things that we expect to happen as the economy heats up is the central bank to cool a little bit and raise rates, and we may see the housing market face a bit of a pullback. Will something else pick up the slack? Are we expecting to see growth elsewhere to offset what could be a cooling in the housing market at some point?
Absolutely. So this is not something that we think happens very soon. I mean, right now, you're still looking at an environment of very low rates. I think the factors that are pushing people into the housing market, I mean, you talk about the low rates, the low inventory, the fear of missing out. All those factors are going to stay in place in the near term. I don't expect to see stiff measures coming out of Ottawa at this point. Although, as you mentioned, you still have some natural factors that will act to cool the housing market. I mean, we're already seeing mortgage rates move off their lows. We expect 5-year bond yields, which is a big driver of mortgage rates, to continue to move higher and end the year higher. And then I think, when offices reopen, you're going to see less demand for large homes in suburban areas, the big driver that we've seen in 2020. I think that factor will wane as people get back to the office, even if it's part-time. We got to think that we're not going to be able to count on the housing market indefinitely. But what we do know also is that governments remain very much committed. We saw the budgets of Ontario and Quebec. There's still quite a bit of support. We're going to have a budget at the federal level next month. And we know that Finance Minister Chrystia Freeland has already promised between 70 and 100 billion worth of extra stimulus for the next 3 years. So we're going to see if that comes to fruition, but there could be some additional stimulus coming out of that. But very importantly, the gargantuan stimulus that we're seeing in the U.S., that's going to wash on our shores as well. So we're going to see strength in exports, and that will drive investment. So there's the current environment, despite the fact that we will see a bit of a slowdown adapted. You look at telework, mass distancing, ventilation. The business world tackled the second wave from a much better level of preparedness. And you add to this the level of confidence and optimism of knowing that the vaccination campaign had begun. And that's how you see, a positive GDP in the first quarter when the Bank of Canada in January was expecting a negative. So I think the more we move into the successive waves, the more the economy is able to handle it. And, that's why I'm not overly concerned about the economic fallout. But of course, it will require heavy government involvement. in terms of supporting incomes, in terms of supported businesses, it will delay that final stage that we hope will happen, which is the final reopening of the economy. So it will require a little bit more involvement. That means higher deficits than otherwise.